Good morning, Friday, July 24th, 8:16 local time in Maui today. Riding from a balcony, you can see Molokai in the background there. Um, Off to the left, looking at it through the video, and Maui's to the right. This is my From the Balcony series, and I'm just trying to get back into a regular routine. I've been following the markets, though it has been detached because of the hours out here. You wake up at 6. It's already noon, and you stay away from a lot of the noise, which has been good. Um, there's still a ton of volatility, though, and basically, that volatility is opportunity. It makes it very difficult, though, on investors and traders alike. In the last, I'd call it 31 days now, you've really seen heightened volatility in the markets, and we see it continuing today. This dispersion is actually really good if you're a active investor, and you can take advantage of that volatility. And we've really seen it, looking back to all the way to 2020. So I think we've been in the golden age of active investing since 2020. I don't think it's apparent yet. It won't be apparent until the indices falter. And I think we're in for a period much like 2000 to 2010, were from today's starting valuations, the S&P 500, the Invesco QQQ Trust, so SPY QQQ, deliver negative real returns, and very likely flat to negative nominal returns. And as that happens, you know there'll be a move away from passive, uh, because passive is just increasingly taking market share. You know, really the last 25, 26 years or so. Because if you look back to 2000, passive was nowhere near as dominant as is today, and that pendulum has swung to an extreme. It will swing the other way because money always follows returns in investments. So once you start to see a period of flat to negative returns from index investing, and there's opportunistic investors that are actively investing outperforming, you'll see a flow of money with a lag, out of the index products. But you haven't seen that because you've had this we had this tremendous run in from the 2009 March lows in indices led by large cap growth. Looked like it was over in 2021 with the SPACs and IPO bubble. But then, in November of 2022, ChatGPT came out, OpenAI, the market's bottom in October 2022, and you've had this Echo AI bubble that has dominated everything. It spread from, the hyperscalers to the NVIDIA to now the semiconductor sectors, the memory, the optical companies, and they constitute, it's cyclical, that space, but semiconductors constitute a huge part. The supply chain of AI constitutes a huge part of the nameplate indices now, which is risk and opportunity. But if you can invest outside of that, there's a lot of tremendous relative bargains. On that note, we're seeing, the second strong update in Cliffs. I wanted to comment on, I did a study about 6 years back, and the number one factor in stock price correlation was earnings revisions higher. So Cliffs now is seeing some pretty impressive earnings revisions higher for the third quarter of 2026, the fourth quarter of 2026. The earnings estimates have more than doubled here over the last 90 days. I think they're going to continue higher. And, we've seen that play out, obviously, in the stocks that have done really well. It just hasn't been, necessarily where our focus has been. We've had some of those, AMD, I've had some Micron, but you really want to pay attention to earning revisions upwards. And you're starting to see that again in Cleveland Cliffs. I think that's a leading indicator for some of the cyclicals. The energy equities, they've seen some earnings revisions higher. There's been a lot of volatility there based on the oil price. But as you really get a move in the underlying, look for the earnings revisions upwards, and I think that'll correspond with the move in the stock prices. When I did that study, I found that earnings revisions were the number one factor that affected stocks. Number two was revenue surprise, and then number three was revenue growth. So I always have that in the back of my mind. When I see earnings surprises, it sticks with me. So there's another class of stocks. So we're looking at that have high free cash flow yields, but they're kind of have been value traps. Charter reported this morning that's one of those. It actually, the estimates were for $10.14 for the quarter. They came in at 10.66. Nevertheless, the stock, which was already down, 67% to last year, opened quite a bit lower this morning. Now it's rallied from the low. It got down to 109. The last I looked, it was around 124. The earnings estimates, if you just annualize the quarter, are roughly $42 for the year. So the PE is in the 3 range for Charter. Comcast is pretty close there. Comcast pays a 5% dividend. Investors are concerned about some subscriber loss in broadband, but they added mobile subscribers. They did the deal with SpaceX. If they can just stem the bleeding, they've got the pending merger with Cox. The starting valuation is insanely cheap here for Charter. And I mentioned in a comment today that Gabrielle Gringo and I, when we talk about the markets, we say that historically equities can have V bottoms. You saw that obviously in the March 2009 bottom. You saw it in the COVID bottom. You saw it in the tariff bottom last year, and you saw it even this year in the late March bottom. That had kind of concluded this. It was concurrent with the Iran war about a month into it, but also you had about a 6-month correction in tech stocks. Then you got that V bottom. So stocks typically V bottom. Commodities are the bottoms are more elongated. Usually the tops are V tops. We saw that with precious metals in January of this year. So if you ascribe that logic to the individual equities too, and that typically is true, Charter might be putting in a V-type bottom here today. So I'm interested to see where it closes. And you're clearly getting, you've got a pullback in large cap tech and tech in general. The Russell 2000 though is outperforming, and part of that, ironically, is some of the biggest companies that were in the Russell 2000, like Bloom Energy. It graduated, it priced out of the Russell 2000. So the decline that you've seen in Bloom Energy, which was, I think, 320, 330 at one point, I saw it 200 here just recently, that is out of that indice because it's graduated. But in general, I think you're going to really see a period of outperformance of small cap value in particular, compared to the S&P 500 to the Invesco QQQ Trust. And I think you're going to see commodity equities outperform relative to the S&P 500 too. So I think we're in that setup. I want to close with, I saw Aaron Turbo posted, the market doesn't care. And, because you have oil that spiked really since July 6th or 7th, although oil's down $3 or $4 today. You've had an interest rate spike, and you've had the dollar stronger. And if you just looked at that in a vacuum, you would say that the market should be a lot lower. The fact that it's not, that breadth is still pretty strong, I think that's a positive right now. That's kind of a breadth divergence. However, it's to be determined what happens, right? If oil, goes up a lot more to, a lot higher price, that's going to affect the markets, or interest rates go a lot higher, or the dollar goes a lot higher, that'll affect the markets too. But right now, breath seems to be really strong in the face of that. That's why he posted the picture of the honey badger, said the market don't care. And it's difficult because Jim Chanos has pointed this out, but in the 1998, 99, 2000, you had a ramp in earnings, which we're certainly getting. This year, S&P earnings estimates are up over 25% for 2026. And Chanos pointed out that you got a ramp in earnings in 98, 99 into 2000, and that was just because of the huge capex build out and spend, which is magnitudes of degrees greater today. However, underneath that, even if you strip out some of that, there's pretty strong earnings growth. And I think the economy, famously in 2000, 2002, we barely had a nominal recession, even though and that's 2 quarters of negative GDP growth as defined, even though the NASDAQ was down 78%. So, just because, and obviously there was a rotation to value and small cap value and commodities, just like I think will happen this time. I actually think the underlying economy is stronger because back then the growth was centric to China, where I would say today growth is more centric to the U.S. because we're reshoring, we're building out manufacturing and industrial capacity. So the economy's more able to handle a big dislocation in tech. Doesn't mean that it's going to be fun. It's going to create a lot of volatility, a lot of opportunity. That's why you have to use options in a limited amount. Be careful with your leverage, and just be opportunistic because you're getting the normal dispersion in a normal year is really high. If you just look at S&P 500 stocks, um, I did a study on that, about 10 years ago, and it was a lot higher than I expected. And if you look outside of that, the price swings are even bigger, right? So what that means is you have to be able to tolerate 50, 60, 70%, you know, drawdowns and advances. And if you can take advantage of some of that volatility, then you have the template to really outperform as an individual investor. So keep that in mind. That's some of the backdrop. I think, to close, the economy's stronger than most people anticipate. There's a big political divide that wants to politicize the economy, but we do have, a momentum of fiscal spending and then reshoring of manufacturing and industrial capacity. And but at the same time, we have this big bubble in technology stocks. Very similar to 99 2000. One difference is we actually had a positive budget surplus in 98 99. Now, it's we have huge deficits. On the order of nearly $2 trillion per year, which is extraordinary. I think that's narrowing, but it's still that's different too. So you have more fiscal dominance than you had back then, which argues for a stronger economy outside of the movement of stock prices. Ultimately, though, I think this is very good for active investors if you can handle that volatility. You're going to make mistakes. I make mistakes. Everybody's going to. The volatility is going to be unnerving, but you have to just manage through that. So, with that, here's a look at Maui again, Molokai in the background. Hope you have a great day. And I'm going to try to write something this weekend to reinforce some of the commentary I just mentioned. Take care, guys. Bye.